Welcome to today's deep dive. I am so glad you're here, joining us as the third person at the table today because we got a wild one.
We really do. It's a fun one.
Yeah, so retail is supposedly, freezing over right now.
Right. The macro environment is just brutal.
Exactly. Inflation is sticky, the job market is pretty sluggish, and consumers are just exhausted by the time they hit the checkout counter.
Yeah, everybody's bracing for impact, just trying to survive the quarter.
But then, right in the middle of this economic deep freeze, you have a discount store famous for like $5 novelty items, and they just posted a 24% jump in sales.
Which is just unheard of right now.
Totally unheard of. So today, our mission is to unpack the phenomenal, frankly logic-defying Q4 2025 financial results of Five Below.
We're pulling all of this directly from their official Q4 2025 earnings report and the earnings call transcript from March 18th, 2026.
Right, and we're going to extract this masterclass in modern retail strategy that's kind of hidden in these financial documents.
Yeah, how does a physical brick-and-mortar store grow its sales by over 24% when everyone else is, laming the economy?
Okay, let's unpack this because the numbers are staggering. Net sales hit $1.73 billion for the quarter.
Yeah, up 24.3% year over year.
Which is crazy. And comparable store sales comps, which is like the ultimate retail health metric, those jumped 15.4%.
Right, and for context, full-year sales reached $4.76 billion.
It's like they hit a home run in a blizzard.
That's actually a great way to put it.
I mean, the environment is cold, people aren't spending, yet they're just knocking it out of the park.
Yeah.
And adjusted EPS beat consensus too, right?
Yeah, $4.31 versus the expected $4, so they're crushing it on the bottom line too.
So how are they doing this?
Well, what's fascinating here is that CEO Winnie Park isn't just crediting this to, luck or one hot toy trend.
Right.
She actually points to a massive structural transformation. They've shifted to this cross-functional flywheel approach.
Okay, pause. Whenever a CEO says flywheel, my corporate buzzword alarm just goes off completely.
Fair. It sounds like jargon.
Yeah, what does that actually mean for the people working there?
It means they completely dismantled the internal silos. So traditional retail works like a relay race, right?
Right. Buyers buy, marketing markets.
Exactly. Merchandising hands the baton to marketing. They run some ads, hand it to store operations, who just open the boxes.
And there are a lot of drop batons in a relay race.
Right. A buyer gets a million toys, marketing ignores it, and the store hides it in the back aisle.
So the right hand doesn't know what the left hand is doing.
Precisely. So Five Below scrapped that. They aligned everyone around 6 specific curtain-up moments.
Curtain up, like theater.
Yeah, like seasonal floor sets. Think Easter or back to school. Instead of slowly restocking, it's a coordinated theatrical event.
Oh, wow.
Everyone starts together. Merchandising, marketing, store teams, they do deep hindsighting on what worked last year and then coordinate the product, message, and execution all at once.
That makes so much sense. You're giving the customer a specific, urgent reason to show up.
Exactly.
It's like you can't get that urgency just scrolling a website. And for you listening, if you're trying to figure out how big companies pivot, this is it. Breaking down those silos directly translated to a 32% jump in full-year adjusted EPS.
But, having a perfectly coordinated curtain-up moment only works if you have an audience actually paying attention.
Right. You need people in the seats.
Which leads right into their massive marketing pivot.
Yeah, so they looked at their traditional TV ad spend and just completely redirected it, right?
Completely. They poured it all into social media and creator content.
To target Gen Alpha, Gen Z, and millennial moms.
Yeah, right where they live on their phones.
And they capitalized on these viral moments. Like the transcript specifically mentioned the squishy dumpling craze.
Oh, yeah. The squishy dumplings were huge.
And they got exclusive licenses for things like Stitch and the Wicked movie.
Right, because traditional top-down TV ads, dead for this demographic. They're amplifying organic TikTok and YouTube Shorts trends instead.
Okay, but I have to push back on this a little bit.
Go for it.
Is building a multi-billion-dollar retail strategy around fleeting TikTok trends like squishy dumplings actually sustainable? I mean, isn't that just chasing ghosts?
It sounds like it. Well,
Yeah. A dumpling is cool on Tuesday, you scramble your supply chain, and by Thursday, kids want glowing slime.
that is the exact trap most retailers fall into. But the squishy dumpling is just the hook.
The hook for what?
Data. Five Below is actively building a CRM, a customer relationship management database.
Oh, so they're capturing customer records.
Exactly. They aren't just reacting to trends. They're establishing direct, two-way, personalized communication loops.
Wait, so instead of just hoping you wander back in, they use the dumpling to get you in the door, get your phone number for a loyalty program,
Yeah.
and 3 weeks later they text you like, hey, the new Stitch plushie is at your local store.
That's the exact playbook. And it extends to physical stores, too. They host these incredibly successful in-store Pokemon events.
Like organized trading card games.
Yeah, and the peripheral sales during those 2 hours more than pay for the extra labor needed to run them.
That is a brilliant loop. The digital viral trend drives the foot traffic, and the physical community event builds the loyalty.
Exactly.
But okay, once you get all these shoppers in the store, there's a new challenge. How do you get them to spend more money without alienating them?
Right, especially when your name is literally Five Below.
Exactly. The name is an anchor. And 80% of their units sold are still $5 and under.
But they're aggressively pushing 7, 10, and 15+ dollar price points now.
Yeah, I saw that. $10 holiday gift sets, remote control cars.
And historically, they kept that stuff quarantined at the back of the store in a section called Five Beyond.
Right, but they've changed that. And honestly, it reminds me of sneaking vegetables into a kid's mac and cheese.
Ah, how so?
Well, instead of putting the broccoli on a separate plate where the kid can judge it and refuse to eat it, you puree it right into the cheese sauce.
That's a great analogy.
They took the $15 items and just blended them right into the regular aisle, so a $15 speaker is right next to a $5 phone cord.
If we connect this to the bigger picture, the psychology of that is just brilliant.
Right.
When you quarantine expensive items, you send a subconscious warning. You are entering the expenses zone.
Yeah, your guard goes up, you clutch your wallet.
Exactly. But placing items contextually, the customer instantly sees the relative value. They're comparing the $15 speaker to a $50 one at a big box store, not the $5 cord next to it.
That makes so much sense. It drove broad basket growth and AUR, average unit retail expansion, in Q4.
Yeah, shoppers just naturally put more expensive things in their carts.
But to pull that off, to have a store that doesn't just feel like a chaotic bargain bin, you need actual human beings working there.
Absolutely. You can't just dump RC cars in an aisle.
Right. And CEO Winnie Park emphasized that they strategically increased in-store labor hours during peak periods.
Which is wild because payroll is usually the first thing retailers cut to save margins.
Exactly. But they used it as an investment. They ensured shelves were stocked and customers were actually served.
Proving that payroll isn't just a dead expense. It supports that high-volume theatrical strategy we talked about.
But expanding into those higher-priced electronics and toys introduces a huge vulnerability.
The supply chain.
Yeah, you can't make remote control cars locally. You rely on overseas manufacturing. Which brings us to the biggest dark cloud in this report: tariffs and global supply chain risks.
It's the unavoidable reality of those higher value categories.
And inventory is up 28%. It's sitting at $847 million.
Right. CFO Dan Sullivan said this was a deliberate pull forward.
So they just bought a ton of stuff early to make sure they'd actually have it.
Yeah, to mitigate transit risks. Plus, they opened 150 net new stores in 2025.
Right, including 8 record-breaking openings in the Pacific Northwest.
And all those stores need inventory.
So what does this all mean? Sitting on $1 billion of inventory is risky when import costs are fluctuating.
Especially with tariffs. Transitory tariffs caused a 160 basis point hit to Q4 gross margins.
Wow.
And about a 90 basis point headwind for the full year.
So almost a full % of gross margin wiped out. For a discount retailer, how do you survive that without just making everything $10?
Management offset penny for penny at the item unit level.
Wait, how?
Through pricing, aggressive vendor negotiation, and product reengineering.
Okay, product reengineering sounds like jargon. What is that, practically?
It literally means going back to the factory and changing the physical design to lower costs. Like shrinking the plastic blister pack on a toy by 2 millimeters.
Oh, so you use less plastic.
Less plastic, and you can fit 3,000 more units into a shipping container. Or swapping a glossy finish for a matte one to skip an assembly line step.
That's incredible. They're redesigning the geometry of the product to beat tax codes.
Exactly, without the customer ever noticing a drop in quality.
But looking at 2026, their guidance is super nuanced. They're projecting $5.2 to $5.3 billion in sales.
Right, and this is a critical detail for anyone tracking corporate guidance. That outlook assumes baseline tariffs remain, but it deliberately excludes the recently enacted 150-day, 10% global, Section 122 tariffs.
Wait, they just ignored a 10% tariff in their projections.
Because they deemed it immaterial to the guide.
How is a 10% hit immaterial?
Because it's only for 150 days. It's a transitory shock, not a structural change. They're signaling to Wall Street that their supply chain agility can absorb it.
This raises an important question, though, about the consumer's breaking point. The CFO warned about a sluggish consumer, high gas prices, sticky inflation.
Yeah, which is why they gave a very measured, prudent 3 to 5% comp guidance for 2026.
Down from 15.4% in Q4.
Exactly. You can defy gravity with a perfect flywheel for a quarter, but you still have to respect the macroeconomy for the year.
So for you listening, whether you're an investor, a marketer, or just a curious learner, Five Below is this real-time case study in extreme agility.
Merging digital creator culture with physical retail efficiency.
Exactly, all while navigating these crazy global headwinds.
But it leaves us with one final provocative thought to mull over.
What's that?
They're building this massive CRM database to form lifelong relationships with Gen Alpha.
Right, the 10-year-olds buying squishy dumplings.
But as Gen Alpha ages out of those toys, will Five Below be able to evolve its product lines to age up with them? Or are they just destined to pass this rich data on to the next generation of 10-year-olds?
That is the ultimate question. Can you grow up with your customer, or are you trapped hunting for new ones?
We'll have to see.
Well, thank you so much for joining us on this deep dive. Keep asking questions, keep looking for the aha moments in the world around you, and we will see you next time.